And so psychology should change and is in the process of changing to realize that you have to think in terms of buying power, not the number of dollars you have. Is the country earning more than it's spending and building savings, or is it spending more than it is earning and creating debt? Because one man's debts are another man's assets. And when somebody is holding those assets and they're producing a lot more of that money in debt, they go down in value. Money goes down in value as they produce it to produce that buying power. And then that gets people bad returns, it produces a higher amount of inflation, and it produces bad returns for holding debt or bond. So in other words, cash or bonds, and then people get out of cash and bonds, and that produces rising interest rates while there's rising inflation, and that produces stagflation. So I want them to get the mechanics of that, because that's happening now. You could see it. This is not controversial. We are producing a lot of debt. We're spending a lot more than we're earning. And as a result, they're printing a lot of money. And the printing of a lot of money creates a lot of inflation. And with that inflation, then nobody wants to, cash is trash. You don't want to hold cash. And you get out of that. And that causes rates to rise. Are you at each other's throats? Is the system threatened? Because history's shown when the causes that people are behind are more important to them than the system is in jeopardy. And that is a risky situation. It's a risky situation because it produces disorder, and it can produce a form of civil war. And at those times, when you have that, you see greater and greater polarity. In politics, it shows up at greater and greater populism of the left and populism of the right. And populists want to fight for their side. They're not moderates. Moderates want to work together to try to find a compromise that's best for the whole. Populists appeal to their crowd by saying, I am fighting for you, and they will fight each other. So when you have a financial problems, and you have this kind of polarity, and you have a bad time, you have a lot of fighting internally. So imagine where we are in the economic cycle. We're in the part of the economic cycle where they have given, the government has given a lot of money and credit to people. They've put it out. Well, no surprise, that's leading to a lot of inflation, okay? Inflation takes buying power away from people. And it also means that then there's going to be higher interest rates, and that's going to squeeze people. And so that makes that wealth gap and that wealth issue more difficult. Well, first thing is you realize that holding cash and dead assets is a bad thing. So a lot of money is in cash because people think that cash is the safest investment. But they are measuring that in the amount of money that they get, nominal returns, and they say it doesn't wiggle much. But think about it. It's lost, as of the most recent statistics, 8.5% over the last, inflation is 8.5%, and they receive virtually no interest rate in cash. And so psychology should change and is in the process of changing to realize that you have to think in terms of buying power, not the number of dollars you have. The worst thing is to be in cash. Like I say, cash is trash, and to be into and to be out of the bonds. The next thing is to have a diversified portfolio of assets. You're better off to own an inflation index bond than a regular bond. It's like a regular bond, except its payments are linked to the inflation, so they compensate you for inflation. Moving from the nominal bonds in which the government just says, I'll give you this amount of money, and it has the unbelievable and unlimited ability to print the money it gives you, it would favor inflation index bonds. And it could be other assets. Some people would say something in terms of cryptocurrencies. I think that people pay too much attention to one at the extreme of the other, that either somebody's all crypto, or they're all gold, or they're all something. And I believe that that's a challenge. I think that crypto, like gold, is not a productivity earning asset, and it can be controlled by governments in lots of ways. It's been outlawed in a number of places, and it also can be monitored. The privacy element is not secure from governments doing monitoring, and the size of crypto is about the size of Microsoft. It's all crypto combined. And so to be overly concentrated in it, in my opinion, is a mistake. I have a little bit about it. I'd probably shock you about how little I have. You would shock me about how much you have, but having some of it. And other things I would say is that geographic location is important. In other words, not just all in U.S. and U.S. dollar assets. I would say that the three things that again I'm looking at if I go down countries is first, are they earning more than they're spending? Do they have a good income statement and balance sheet? This is going to be very important in the period ahead, because the amount of credit that's going to be available to bridge the gap between spending and earning, cash flows and so on, is going to be quite narrower. So a lot of companies even that were able to raise cash and not have good cash flow because of maybe growth expectations in the future will find it more difficult. That'll be true for individuals, it'll be true for countries. So does it have a good income statement and balance sheet will be important. The second is places. How are they working with each other? Is there civility, or is there civil war, on the brink of civil war? Because countries where they work well together, they're productive, are going to have a real competitive advantage. Orderly places, safe places to be,